Surely you've heard about interest at some point in your life, and unfortunately, most of us learn about interest as something extremely bad early on, either in childhood or adolescence, when we hear our parents talking about having to pay a bill or they'll have to pay interest on top of it. Or when they mention that they owed $5,000 to the bank, but with the interest, the debt grew to $20,000, for example. And it's true, all these debt-related interest rates are also compound interest, which is interest applied to the total amount, not just the amount owed. If you didn't quite understand, let's go with a simple example. Let's say you owe $10,000 to the bank and the interest rate is 10% per month. So, at first glance, we know that if you wait 1 month to pay, you'll have to pay the $10,000 you borrowed, plus 10% of that, totaling $11,000. Now, let's say you take 3 months to pay. In this case, the interest on interest will cause the debt to grow exponentially because you will have to pay the $10,000 plus 10% in the first month, plus 10% in the second month, and 10% in the third month. In other words, the $11,000 from the first month and 10% more in the second month, which will be calculated on the $11,000, reaching $12,100. Finally, in the third month, the interest will be on $12,100, totaling $13,310. Notice how the interest on interest makes a significant difference over time. Now let me ask you, if someone takes a $10,000 loan at 10% interest per month, how much would they have to pay after 10 months? Well, you might think that after 10 months, with a rate of 10% per month, they would have to pay 100% interest, or $20,000, because it would be $10,000 plus 100% interest. But you'd be wrong. If we were talking about simple interest, you'd be right. But the topic here is compound interest, meaning interest on interest. And this is how the world works with compound interest for both debt and investments. Thus, we find that if the person takes 10 months to pay off this debt, they will have to pay $25,937.42 instead of just $20,000. See the difference? Now, speaking of investments, whenever we invest our money and receive monthly returns, and instead of spending them, we reinvest them, we are making the effect of compound interest work in our favor. Of course, when we talk about investments, the interest rates are much lower compared to debt interest rates. By building a diversified portfolio of good fixed income assets, real estate funds and stocks, for example, we can achieve an average return of 8% to 15% per year. So, using the previous example as a base, let's say you invest $10,000 just once in an investment with a net return of 10% per year and always reinvest the returns. How long would it take for you to double that capital? And as you know, it won't take 10 years, because we're talking about compound interest. In fact, it will be much less than that, around 7.2 years. All of this thanks to the Rule of 72. But don't worry, I'll explain this rule in more detail shortly. As Albert Einstein said, compound interest is the 8th wonder of the world. Those who understand it, earn it. Those who don't, pay it. Now that you understand the magic of compound interest, let's go straight to the Rule of 72, which you're probably curious about, right? Just so you know, this rule was first mentioned in a book published in 1494 by Luca Pacioli, who is considered by many as the father of accounting. So we're not just talking about any rule, but rather a method that's been used for over 600 years. The Rule of 72 is a simple way to figure out how long it will take for an investment or debt to double in value. It's like the example I gave about investing $10,000 once at 10% per year and reinvesting the returns. Many people think that the capital would double in 10 years, but using the Rule of 72, we find that it would actually take 7.2 years. To get this result, it's just a simple calculation that anyone can do in their head. Take the number 72 and divide it by the annual return rate, which in our example is 10%. So we know it would take about 7.2 years to double that capital, assuming you only invested the $10,000 once and just reinvested the returns without adding any extra money. To make it clearer, let's look at another example. Say you have a $10,000 debt with 30% interest charged annually. How long would it take for that debt to double? It's super simple. Take the number 72 and divide it by 30. That gives us 2.4 years, meaning it would take about 2 years and 5 months for that debt to double. See how simple and interesting this rule is? Now let's say you have $100,000 invested in a diversified portfolio with fixed income assets, real estate funds, and stocks, generating an average return of 12% per year. We can calculate how long it would take to double that amount. Just take the number 72 and divide it by 12, which is the annual return in our example. We conclude it would take about 6 years to double the capital to $200,000. This rule considers two things. The first is the effect of compound interest over time. As I mentioned earlier in the video, to see the impact of compound interest, you need to reinvest the returns to get that famous effect of interest on interest. The same thing happens with debt. When someone doesn't pay month after month, the interest on interest keeps increasing the amount they owe. Now, the second point is that the rule gives us a rough idea of how long it will take to double an investment just by reinvesting the returns without adding any monthly contributions. For example, if you already have a certain amount invested, you can use the rule of 72 to estimate how long it will take for your investment to double just by reinvesting the returns without putting in any more of your own money. So, if you have $50,000 invested, earning an average of 12% per year, in about 6 years, you'll have $100,000 without adding anything else, just letting the money grow with compound interest. Now, it's worth noting that in this calculation, I'm not factoring in the effect of inflation over time. But if you want to know the real return, accounting for inflation, a safe and diversified investment portfolio tends to yield around 6% above inflation. This can vary since both returns and inflation fluctuate, but we can use this average of a 6% annual real return after inflation. This way, we can apply the rule of 72 by dividing 72 by 6, which is the annual return in our example after factoring in inflation. We get the result that it would take 12 years to double the capital. In other words, after accounting for inflation and considering a real return of 6% per year, it would take around 12 years for the capital to double. Yes, when you look at it that way, it seems like a long time. But as I mentioned, the rule is just to give us a rough idea of how much we'd have on average without adding more money monthly. However, if you're subscribed to this channel, you already know that investing every month, along with reinvesting the returns, is what will truly accelerate the growth of your investment, especially if you're able to invest a significant amount each month. The rule of 72 dates back to 1494, but nowadays we have logarithms, and when calculating with the compound interest formula, we find that the more accurate number for this rule is actually 69, not 72. But since 72 has more divisors, it allows us to do the math in our heads more quickly. And when comparing the results of the rule of 72 with that of 69, the difference is very small. So for rough estimates, the rule of 72 is still widely accepted. It's a simple way to understand how compound interest works, showing that earning 10% per year doesn't mean it will take 10 years for the investment to double. I want to remind you once again, this rule is just for an approximate view since both investment returns and inflation fluctuate over time. Always use compound interest to your advantage because it will be one of your greatest allies in achieving financial freedom in the long term. Compound interest can truly make your money work for you. I hope you enjoyed today's video. If you have any suggestions, feel free to leave them in the comments below. I'll be reading them. Thanks for watching, and I'll see you in the next video.